Hello and a warm welcome to Portfolio Watch. I'm Gugulethu Mfuphi. Now in today's episode, we take a look at a challenge that many of us as investors face, especially during difficult times. How do you remain resilient during turbulent times experienced on the financial markets? Losing money is quite an emotive element and of course can lead to us taking very short-term decisions. But to help us manage this particular process, we joined in studio by Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Gary Booysen, Director and Portfolio Manager at Rand Swiss. Gentlemen, great to have you both with us. I think quite a critical topic, especially for many of us as South African investors who might be overweight on domestic equities, right? Given the fact that we haven't seen much growth here, we're obviously quite concerned about the level of just not gaining more appreciation on our capital. So how do we face these turbulent times here, Andrew?
Yeah, so I suppose if you look back over the past 5 years, I think the JSE is essentially flat in real terms once you've taken into account inflation. So we've heard Japan, been spoken about the lost decade that turned into the lost two. We're already halfway to a lost decade, which is quite concerning. Hopefully it doesn't continue to the full decade. But then when you look around at global markets as well, suddenly, over the last couple of weeks, there's been a huge amount of volatility and suddenly investors are starting to get nervous. We've been so used to, specifically if you look back, I think last year, 2017, the markets, was very smooth. There was very little in the way of volatility. And we've forgotten already that February we saw the market down, I think about 10%, the global market. There was a lot of volatility and then the markets picked up, reached new highs, investors forget about it. And, when markets are going up and when there's volatility just to the upside, everyone's happy and no one really minds about it.
Sure.
But, if one thing you've got to know, if you invested in the markets, it doesn't go up forever, and at some point it is going to go down and there is going to be times of volatility, and I suppose that's when you've got to keep your wits about you and not make emotional decisions when you suddenly see the market pull back a bit. It could just be a healthy reset, which is probably what this market needs.
Yeah, very interesting dynamics that we've seen from a global perspective, especially Gary, if you take a look at what we've seen from US equities versus the East and of course coming out of Europe. What's your analysis as to how we need to respond in such turbulent times to the markets?
Now, certainly, when you do see stocks and equity markets selling off, generally it does present opportunities because it tends to overshoot. Just like on the upside, when everything is going well, the markets seem to go up a little bit more than they potentially should if you look at the underlying fundamentals of companies, and that's probably the time to be reweighting out of equities and trying to get out. Unfortunately, retail investors almost always do the opposite. So when markets fall, you feel the pain. You look at your performance and you think, I've made a bum investment. I should never have invested in stocks in the first place. So at least times of opportunity times of volatility at least are times of opportunity for me, but certainly if you look across the globe at the moment, it hasn't been easy anywhere. Really, one of the few pockets of I suppose performance that you could have picked up is in that kind of mega cap US tech and services and financial sector. That's where all the gains have been generated. And we look at South Africa, and Andrew was saying 5 years we're flat. This is not just a South African story. This is not because of our own policies or anything. Partly it is, but on the whole, if you look at China, you look at Brazil, you look at Russia, you look at even Europe to a large extent as well. It's equity investment has been a difficult place for the last couple of years. Just because I suppose we have rising yields overseas, which makes fixed income assets a little bit more attractive, and that naturally sucks money away from the equity markets. So I don't know, is this the time to buy though in South Africa? It's difficult because my colleague keeps on pointing out that there's, if you're looking at developed markets, yes, on average markets go up, use volatility to buy in. Yeah. But if you look at emerging and frontier markets, there's plenty of examples, and I'm not even talking about Japan, which is a developed market, but there's plenty of examples. I'm thinking Venezuela, Syria, Zimbabwe to an extent as well, where you invest in times of volatility and your investment just never recovers.
Exactly.
So you've got to be careful.
I'm glad you bring that up because for a lot of retail investors, we know about the VIX index, we hear about it, and we often use that as a proxy to kind of gauge our views as to how opportunistic the market might be at the moment. For in layman's terms, though, decipher it for us, and if we should actually be using this as some kind of indicator.
Well, the VIX is it's the CBOE volatility index, which is a prediction of implied volatility on US markets. So it's we have the Savvy in South Africa, which is like the South African VIX, which gives you the volatility on the South African market. But essentially volatility is, Andrew was sort of touching on it earlier, it's a measure of movement in the market. It's also a measure of the supply and demand of options as well, as another way that you can think of it. But essentially, I suppose in traditional portfolio management, it's a measure of risk, although it's a very limited measure of risk, if you want to put it that way, because there's many risks that are not taken into account when you're looking at volatility. And I think, to what we were discussing before, if you look at the potential for a market never to recover, that's not implied in volatility as a risk. I mean, a catastrophic risk is not included in volatility. So, but generally, if we're looking at the CBOE, the VIX, for the whole of 2017, where Andrew was saying that you've got this very, very smooth path up, especially in the US markets, the VIX was trading between kind of 10 and 12. In February, when we got that 10% correction, it spiked to about, I think, 37. It's now spiked. This little patch of volatility that we see now has only taken us to about 28. 2008 crisis, 80. So this is just a mild bout of volatility. We're not really sick. This is like a cold.
But we feel like
maybe
that,
take
right?
the day off work and like some over-the-counter medication. That's all you can have. But this is certainly not. This is not 2008 all over again, or at least not yet. This is just a small and what to Andrew's point, a very natural correction.
But that's not how we feel like as investors, right? Because we're quite emotional about our money and we feel as though, oh, woe is me, what should I be doing? Especially when we take a look at the local dynamics of the equities market space. How have you tried to manage the emotions and money when it comes to the investment decisions that you take on behalf of your clients?
Yeah, I suppose it's very easy, when you look at your portfolio going backwards to make those emotional decisions, and it's difficult to not do anything. But you've got to, I suppose, ensure that your portfolio is calibrated, if I can use that word, correctly. If you've got the right sort of asset mix, the right exposure to, if you're not overly exposed to equity markets or emerging equity markets, as long as your portfolio is positioned correctly, you should be able to see through periods of volatility. And as Gary says, I don't see any excesses in the market at the moment. We're not really in like a bubble territory, so I don't think we're going to be seeing a massive sell down of 20, 30, 40%. So a bit of volatility, a fall of 10%. You go back every single year, there's always drawdowns. No matter what year you look at, you're always going to see drawdowns in the region of 10% or even more. And more often than not, the market still ends the year in positive territory. So you just need to be able to ensure, if your portfolio is positioned correctly, that you can sit on your hands, ride out the volatility. And I'm sure that down the line, long term, whatever your longer term view might be, I'm sure you'll look back and it'll be just a blip on the radar screen.
A blip on the radar screen. But there's also opportunity, right? And buying opportunity. And I am assuming some of these stocks that we'll delve into just might be some of those sweet spots in the market that we could tap into. Yeah,
so I mean, you look at South Africa, gone nowhere for 5 years. There's most definitely opportunity on the local markets. Specifically in your mid and smaller cap space. For investors that are willing to go there.
Yeah.
I think there's definite opportunity. And even if you look offshore, besides the US, Gary mentioned it, the US has kind of been the only market that's really done the heavy lifting over the past few years. Markets around the rest of the world, haven't really gone or haven't done a hell of a lot. And Japan is a very good case in point as well. There's a market that is exceptionally attractive from a valuation point of view. Yet no investors really look at it because it doesn't have these big, sexy tech stocks. It's an economy that's gone nowhere for a very long time, since the late 80s. So global investors have tended to forget about Japan. There's huge opportunity there as well.
Sure. Gary, you wanted to add on to that?
I was just saying, we keep talking about the flat South African market as well. But I mean, if we kind of do this on a level playing field and we do this in a constant currency, if you look at our market in dollar terms, we're just about at a 40% correction at the moment. So, I mean, if you're an investor that's looking at a global approach, you need to you need to measure what your base currency is as well. And I mean, we've kind of suffered the collapse almost already in my mind. And I think to Andrew's point around small and mid caps, I mean, we're seeing a lot of these small and mid caps, private equity firms coming in, buying the entire share issue and delisting them. And that for me just says that the smart money is looking at these counters and saying there's absolutely value here. Why do they need to remain in the public space?
Sure. So take up the opportunity for yourself and enjoy the growth in the long term, right?
That's it.
But we also want to be part of that, and exactly that brings us to our discussion around equities and looking at particular stocks that do present these opportunities. Looking at one particular stock, and this one's directed to you, Andrew, more in the consumer space with regard to fast-moving consumer goods, AVI. When I think of that company, I think biscuits, tea, and shoes.
You think correctly, because that's exactly what they do. Yeah, as you said, it's predominantly a food producer in the FMCG space, but it's also got its fashion and personal care. I think when you're looking at times of volatility and turbulence, and I suppose even looking at what South Africa's been through, you want to be investing in companies that have a certain defensive element to them, as well as being incredibly well run and a strong management team. And I think if you're looking for a strong management team, I think AVI is a clear case in point. You can compare them to what some of the other food producers have done recently in South Africa. Tiger Brands, Pioneer Foods, the list goes on. AVI is incredibly stable when you look at the profitability that they've been able to generate, return on equity of around 30% through the cycle. Even this difficult period where they're going through now, where consumers are under pressure, so prices are under pressure.
Yeah.
They've managed to grow their top line, grow their earnings in a very, very difficult environment. Every 3 years they pay a special dividend. They a very good dividend payer, stable dividend payer with growing dividends over time. Good management, capital allocation, superb. I think in times like this, a company like AVI is a very good investment, or presents a good investment case.
So it brings about a good investment case, and of course speaking to that consumer trend, which I want to throw to you, Gary, by taking a look at some stocks that you've selected, the likes of Heineken and of course ANH, Anheuser as well.
Yeah, so it's a little bit of a different, I suppose a little bit of a different tack with those, very, very different play to from an AVI. I mean, AVI also, I do like AVI. I mean, it's, I think it's one of the companies that, if you look at the kind of the forward PE of AVI at least, I mean, it's trading on about 18. It usually trades on about a 22. So you can see that there's been a multiple unwind there as well. So I think again, it's just, that's a stock that's just being hit by the pessimism. I mean, we've got a price target of about 110 on AVI. But if we go to Heineken and Anheuser in there,
yes.
So these are the booze stocks, and they are under all sorts of pressure, I suppose, at the moment. And part of it has got to do with health trends, part of it is regulatory, part of it is declining volumes as well, because you've got obviously regulatory impact, but you've also got people moving away from to craft beer and wine and spirits and other things. But if you look at them kind of long term, I suppose the other criticism, I'm first going to give you the criticism, then I'll give you the bull case. But the other criticism is that obviously we are in an increasing rate environment, and if you look at these are very different from an AVI kind of pick. These are the Anheuser InBev makes 1 in 3 beers internationally. It's absolutely enormous. Same with a Heineken. I mean, a Heineken, not the same amount of beer made, but it's also one of these giant sort of like multinational behemoths. Unfortunately, even though they pay very good dividend yields, you are going to see, obviously, with the rising rate environment, that alternative products, fixed income products, become maybe more attractive. Now, the question an equity investor has to ask is, how much of this has been priced in already? So we've seen both the stocks under enormous pressure in the last kind of, let's say, year, maybe year and a half as well. Now, if you look specifically at AB InBev, a lot of that has got to do with potentially them cutting their dividends. That's kind of where the speculation is coming from. Obviously, they made the acquisition of SAB, our local brewer, and that they took on a lot of debt because of that. Now, obviously, again, you've got this rising rate environment. Investors are looking at this and saying, "Oh, your debt is quite expensive. What are you going to do about that?" And people have sort of been penciling in, you could basically get your debt down to about 2.5 times EBITDA, which I think is where the target is. It's sitting at about 5 times EBITDA at the moment. This will kind of alleviate our fears, because we've got Moody's at the same time coming and downgrading their I think they're on A3 at the moment. They've downgraded it to a negative outlook as well. So you potentially get their credit downgraded. So a lot of bad news around the stock, but the share price is reflecting that. Now, we've got a sell-side analyst on this that we chat to, and looking at it, we really don't expect the dividend to be cut. We expect that leverage to unwind over the short term. We've got a target price of 1,600 on the stock.
Andrew, is this one that you hold and quite keen on?
Yeah, so Anheuser-Busch, we do hold it. We don't hold Heineken in our global equity portfolio, but we do have exposure to Heineken, in certain places.
Sure.
The debt, Gary touched on the debt, and I think that's the big issue with Anheuser-Busch. And you must also remember Anheuser-Busch is also heavily exposed to emerging markets.
Yes.
And we know what's happened to emerging market currencies this year. So that's also weighed heavily on the share price. Plus, these guys are both European listed. European markets haven't really gone anywhere. It's the US that's done everything. But from the debt point of view, Gary says he doesn't think they're going to cut the dividend. Whether they do or don't, I'm not sure, but I think it wouldn't be a bad idea if they actually did cut the dividend. And we saw this a couple of years ago with the resource companies when they cut back their dividends, shored up their balance sheet for a year or two, and then reinstated them. And I think that might not be a bad option for Anheuser-Busch, just to get those debt levels down to, whether it's manageable right now or not, I'm not sure, but the investment community definitely don't like it at the moment, so it might not be a bad idea.
So just also, one more interesting point about like the emerging market versus developed market story as well. So I always had a look at the emerging market sales of Colgate versus developed market sales of Colgate. And you saw developed market very stable, and with the emerging market crisis we currently go through, Colgate absolutely imploded. Beer, no difference. So people, we kind of extrapolating that people would rather, in tough times, drink beer than brush their teeth.
Exactly, right? So clearly a strong investment case there for both Anheuser-Busch and Heineken. Hopefully those talks about a potential takeover deal there also might subside over some time. But we're going to take a brief break now. We want you to keep your feedback coming, so you can email us on portfoliowatch@abn360.com or tweet us at CNBC Africa using the hashtag PortfolioWatch. We've got a few more stocks lined up for you right after the break, the likes of British American Tobacco, CMH, as well as Philip Morris Imperial. Stay with us. Welcome back. You're still watching Portfolio Watch, where we're focusing on our theme this evening being how exactly we need to remain resilient as investors, especially during turbulent times on the equities market. Joined in studio today by my guest, Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Gary Booysen, Director and Portfolio Manager at Rand Swiss. Now, just before the break, we certainly took a look at companies that are aligned with the consumer goods element, whether it's AVI, Heineken, as well as, of course, the likes of AB InBev. But what about when it comes to the likes of CMH? Company that's involved with regard to logistics as well as the movement of vehicles, and as we know, that's usually a strong indicator of how the economic performance of a country is actually doing.
Yeah, absolutely. So when you think about a defensive share, you're not going to, CMH is definitely not going to be one that jumps up onto your radar, immediately. But CMH, a very cyclical business. When you think about vehicle sales, when, as you say, when the economy does well, new vehicle sales tend to pick up, and then you'd think that CMH would have battled over the last couple of years, given that what's happened in the local economy. But it's actually done very, very well, and it's a well-managed business. So this comes back again, I suppose, to the management capability. Jeb McIntosh, who's the CEO, has been there for many, many years, and he's proven himself an astute leader of this business. And when times are tough, people don't necessarily stop buying cars. Instead of buying your 7 Series or 5 Series BMW, maybe you buy a 3 Series, and instead of buying a brand new vehicle, maybe you go and buy a second-hand vehicle, and this is played into their hands. So second-hand vehicles is a very strong element of their business, and as a result has protected them from this downturn in new vehicle sales. Motor distributors also make their money not necessarily just from selling vehicles, but from servicing their vehicles as well. So when you take your car, so if you're keeping your car for longer now because you're not selling it because times are tough, you don't want to buy a new one, you continue to service it. And anyone who's had a car that goes out of motor plan and you take it to the distributor to service, you know what it costs. That's where they make the real money. So that's also playing into their hands right now. Then they've also got their rental business, First Rental, which you'll see at all of the airports. That's also CMH. And it's a small cap company, so it comes back to what we spoke about earlier, small and mid caps. And if you're looking for value, this is a fantastic opportunity on a PE of 7 times, a dividend yield of about 8%.
Sure.
You don't get opportunities like this for a business that is able to grow its top line and its earnings during difficult times, and then obviously as well as in good times. So it's a very interesting little investment opportunity.
As you say. So hopefully no challenges with regard to liquidity there, but lots of strong growth potential. Interesting to see in future how this might be rattled by the dynamics that we talk about vehicle sharing and autonomous driving as well, coming into markets like South Africa. Gary, I want us to go abroad again, taking a look at Philip Morris as a potential investment case here.
So Philip Morris, as long as you don't mind investing in a company whose products kill their customers. It seems to be very, very reasonably priced. So again, we're going to kind of look at both the big tobacco stocks, because traditionally when you've got markets under pressure, this is kind of where the investors' minds move to. It's we should buy companies that people are addicted to their product, and show very little volatility depending on how incomes are growing or shrinking, and
Sure.
and really has a very kind of stable, I suppose, sales line. But again, you look at it, it's facing some of the same kind of macro concerns that alcohol company would face, just being large and kind of being an alternative with its these very attractive dividend yields. So it's sitting, I think it's on about I think it's about a five times forward dividend yield. So looking 5% at least forward for 1 year forward dividend yield. So it's it's returning money to shareholders, and it's actually managing in constant currency terms to grow revenue as well, which is surprising in a shrinking market, because you would expect, again, health trends to come to play. But if you look at it, you put aside the regulatory concerns, you put aside that, and you just look at the pure valuations on the company, it is very, very cheap. These cigarette companies trade at probably I'd say it depends which peer group you compare it to exactly, but I mean, if you compare it to general consumer staples, probably at a 40% discount. So you're getting a significant discount for a company that isn't going to go out of business. Sure, we've seen changing regulations, and that's really what knocked the stocks in the beginning of the year. But we've just seen the FDA coming out a little bit more aggressively against the sale of products to teenagers, because they're looking at teenagers as a new market, and saying especially the next generation products, so the the vaping and all of that. But the problem with that is that the manufacturers don't actually control the retail outlets. They don't control who sells the products to teenagers. So it's actually the responsibility is most likely going to fall at the door of the retailer, not the manufacturer. And then it's natural that these regulations do move very slowly. The first kind of cancer study that came out was in the 1950s, and in response to that, tobacco companies added filters to their cigarettes and market them as the safer alternative to people that were concerned about cancer. So it's I wouldn't count out what I'm trying to say is I wouldn't count out these tobacco companies anytime soon. And I mean, looking at a company like Philip Morris, I mean, it's kind of trading on a PE of about 17 times, which is significantly lower than it used to trade at. And when you're going into kind of turbulent markets, what you're looking for really is you're looking for companies that you are sure are going to survive, but at the same time have seen a big re-rating in their share prices, that when good times come back, you have a high chance of that re-rating higher again. And I think tobacco, very clearly ticks that box.
Yeah, you've mentioned two very critical points there about making sure that these companies can survive, and of course understanding the business case behind it. But retail investors in South Africa, Philip Morris or British American Tobacco, same kind of industry, but of course very different portfolios regarding diversification. Yeah,
different portfolios, absolutely. Philip Morris International looks primarily at actually emerging markets, so it's not US based, whereas British American Tobacco, after the acquisition of Reynolds American, actually has a far bigger US customer base now than it did previously. Now, it's very difficult to compare the numbers at the moment, one for one, because that acquisition is kind of skewing everything. I mean, you're seeing huge jumps in revenue after the acquisition. I mean, they've got a lot of work to kind of do there. They also need to, almost do what AB InBev is doing at the moment and bring down their debt, because they've also been fairly acquisitive in a time where I suppose, the market has been under pressure, which I think is a good time to be acquisitive as well, because I think you're consolidating a market that is cheaper than it would otherwise be. So, given the kind of risk factors that I've highlighted and the reasons not to invest, I still think on a pure numbers and valuation play, investing at these levels in either of them will give you significant upside over the next, say, 5 years.
Yeah, I see that you...
And they're both rand hedges.
And they both rand hedges, see? So a realist and, of course, still seeing opportunity despite the murky waters that exist. Andrew, to come back to you, Rickert Benkisser, not something that a lot of South African investors are familiar with. Introduce us to the stock and, of course, the investment potential here.
Yeah, so Rickert Benkisser, you might not be familiar with the name, but you'll be familiar with many of their products. So they're a manufacturer and marketer of home care products, healthcare products, that sort of thing. So Dettol, if anyone's got kids, Nurofen is a medicine that you give your kid when they're not feeling well. Yeah. My wife lives by it. There are many more. When you think of Harpic, Vanish, Finish, the tablets that go into dishwasher, that's all Rickert Benkisser. So they do a lot of healthcare and home products. And you think about businesses that are going to last for many, many years. So this is obviously a consumer staple business, so fairly defensive. But when the times we're living in, when you think about disruption and companies that are going to get disrupted, you can think about disruptors and inevitables. And inevitables are companies that are probably never going to get disrupted because their products are always going to be used. And I think Reckitt Benckiser is a very good case in point for business like that. So it's listed in the UK. It's a London business, or London-based headquartered business. So as a result, we know what's going on in Brexit, what's happened, to the pound in recent years, I suppose, negative sentiment, and this share has been hurt quite badly by that. Consumer staples, by and large, have been under pressure for some time. But I think in this market now, when everyone's been paying up for this growth, and things start to get a bit volatile, I think it's not a bad bet to get some exposure to some more defensive businesses. Reckitt Benckiser would be a very good case in point. It's a very similar business to Unilever. We'll all be more familiar with Unilever.
Procter & Gamble as well.
Procter & Gamble.
Yeah.
It's the exact same sort of business, UK listed. So it's very defensive. I think it's a good opportunity right now, given that it's been under pressure. Valuations are looking good, and it's got a great portfolio of brands.
Yeah. Interesting to see the minds of consumers, right? We might not brush our teeth, but we're happy to have clean bathrooms and toilets in our homes too, as we enjoy a beer. So for you as viewers, I hope that you've been enlightened today by many of the stocks that we've highlighted, and of course understanding that sometimes there's an alternative way of accessing the markets through ETFs, some of which we haven't even touched on, like the iShares Nasdaq Biotech ETF. But if you'd like to find out more, please do keep your feedback coming on social media. So tweet us at CNBC Africa using the hashtag Portfolio Watch. Alternatively, send us an email, portfoliowatch@abn360.com. But in the meantime, a big thank you to both my guests for joining us this evening. Andrew Dittberner, Chief Investment Officer for Private Client Securities at Old Mutual Wealth, and Gary Booysen, Director and Portfolio Manager at Rand Swiss. From myself and the team, we'll see you again next week.